We've seen a significant crash across many of the technology stocks, and this has been accompanied by layoffs across many of the leading technology names, from Peloton to Tesla, Shopify, just to name a few of them. Of course, if you've read any newspaper, article, or watched any video, I'm sure you might have heard about the discussion surrounding the layoffs, the uncertainty in the sector, but also questions about what this could mean. So today we're going to unpack some of the drivers about why these technology layoffs are happening, but then we're also going to talk about the potential implications for the technology stocks and also the recovery in the broader technology sector. To start off with, to understand the layoffs themselves, what's the story? I'm sure you would have seen some of these articles, whether it was Wayfair, Robinhood, LinkedIn, Tesla, of course, with Elon Musk discussing everything, Microsoft. Many of these leading names have really started to discuss about cost-cutting measures, winding down some of the excess spending that's been going on. And of course, as we know, the era of free money is now over. We're into a rate hiking cycle. And as a result of that, many companies, not just isolated to the technology sector, are becoming much more prudent with their spending and focusing on profitability and cash flow generative activities. So there are a few different drivers about why these layoffs have been happening. First and foremost, a lot of it centers around pandemic exuberance. Of course, we have heard about that phrase of the pandemic winners. It was not isolated to only technology names, but many of those stay-at-home winners really shone through in 2020 and 2021. Whether it was the buy now, pay later sector, e-commerce, some of those software as a service offerings, many of them had significant demand, and they ended up building a lot of infrastructure surrounding this, anticipating that the growth rates and demand would perhaps be sustained moving forward with the new normal. Of course, as we've started to see the reopening trade occur, we've started to see some of those elevated demand patterns start to get back to more normalized conditions. Perhaps some of the infrastructure and the spending that was built out was a little too exuberant initially, and we're starting to see a lot of these measures be wound down. Of course, we've seen significant effects in terms of share price performance from many of these names: Peloton, Netflix, PayPal, Teladoc. These have been synonymous with the technology stock sell-off over this past period. Now, of course, share price performance and spending decisions are distinctive. However, with elevated valuations, periods of free money, and markets that are prioritizing growth and growth at any costs, this led to a period where there was significant excitement in the market and a lot of spending was going on. But we're seeing this starting to be wound down. And this leads us to the second point, prioritizing profits now over growth. Of course, we've come from a period where it was all focused on what's the revenue multiple. Investors were willing to pay just about anything for growth, particularly in the earlier stages of 2020 when we were in a no growth environment. Investors were willing to pay up for growth. There was the teeter alternative where there was no alternative, and we saw many of these companies continuing to be bid higher and higher and higher. We of course saw stretched valuations. We've started to see a multiple contraction during this period, but there's also been a focus from the markets now, focused on cash flow generative companies in the here and now with strong balance sheets versus those that are pricing in growth but a long term into the future. And we've started to see that with the rising interest rates and consequently the rising discount rates affecting particularly the growth end of the market that have got long duration cash flows. Now, this has happened to many of these technology stocks, but a sector that we've really seen it come through quite significantly is the buy now, pay later company. Sezzle, a US-focused buy now, pay later company, and Zip have both stated in some of their recent reports this focus on profitability in the near term now. They're really prioritizing that, perhaps winding down some of their non-core growth initiatives and really focusing on core business in terms of products and regions, as well as accelerating the group's path to profitability. And then the third one here as well is cost cutting. Of course, all of these are intertwined, they all feed into each other, and there's a lot of interplay between all of them. But from one of the recent Shopify earnings calls, there was some fascinating insights that we could take away surrounding the mindset that many of these technology companies are having. We know that Shopify is a big enabler of many of these e-commerce offerings around the world. They're playing the B2B space, but they really were one of the big winners, not just during the pandemic, but before that. However, they also have got a renewed focus over the past period. And I think some of the words here that were spoken were fascinating. Before we discuss those, if you haven't yet and you're new here, make sure you subscribe to turn your bell notifications on. Plenty of videos coming at you. We cover all things on the markets and the macroeconomic picture, so welcome. In terms of the Shopify earning call discussion, as you can see here, some of the wording. During the pandemic, we made a bet that retail spend would disproportionately favor e-commerce at a much higher pace than it has. The belief was that the channel mix, the share of dollars that travel through e-commerce rather than physical retail, would permanently leap ahead. So that's moving into a new normal. We saw it happen, but the question was, would it be sustained or would we revert back to normalized conditions? As they built for the digital leap, they stepped up their efforts, they expanded the company accordingly. Of course, they couldn't know for sure at the time, but if the prediction came true, they would need the infrastructure there to be able to feed into what would almost be an insatiable demand as everything started to come online. However, fast forwarding to now, a couple of years later, things have turned out differently. We've seen how the world has got back to more of a normalized operating condition. With a normalized rate of spend online, the reset has occurred. It's higher than it was in 2019. We all know we're using much more digitized day-to-day operations, but the rate is lower than they'd planned for. In short, they overshot the prediction. They invested heavier than was ultimately necessary at this stage. They're recalibrating their investments and spending and making sure they're not sacrificing components that are critical for the future. However, they're really right-sizing into the here and now. And we've seen this play out across the sector, but I think Shopify really helped to conceptualize it in quite an easy to digest form. We saw Shopify provide this overview by reducing their headcount by 10%. They made the difficult decision there. They provided some follow-up wording as well in terms of, in addition, for the remainder of 2022, they expect to reduce spend in low priority areas and non-core activities that they don't believe will be as effective in this environment, focusing on the sales, the marketing spend, on activities with shorter payback periods. We know the market's prioritizing these activities now, and realigning the support teams into a more efficient operating model. We know that many companies are going to come out of this period a lot more efficient, perhaps leaner than they did coming into this period. But of course, some of the key areas where they can strip out some of that excess includes in terms of the marketing spend, in terms of headcount, obviously prioritizing recruitment focuses rather than just hiring as many people as possible. And we know that we've got this tight labor market at this current time as well. And so in terms of what do we watch and what are the implications? WiseTech Global, one of the leading logistics companies, reported earnings today. They were up by over 12%. The market liked what they saw. It's worth noting that WiseTech is a company that's already currently profitable. It's not one that's looking to move towards profitability in the future. It's got a strong balance sheet. And the founder, Richard White, referenced the WiseTech earnings today and provided a fascinating insight. He said 5 years ago, even 2 years ago, people wanted to work in startups that had really no product, no revenue, but were just an idea. I'm sure you've got friends, family, you've heard about people who are all really excited about the startup space. And of course, there's still a long way to go. Innovation's only in the very early innings, but it's just talking about that mindset and sentiment. However, Richard White stated WiseTech does not have that problem. It's been profitable for so long, he can't remember not turning a profit. And all of a sudden, what White describes as a 20-year war for talent is starting to turn in his direction now. The employee hire rates picked up substantially in the last 3 to 4 months. They've actually noticed it over the last half a year, quite noticeably, as layoffs have actually been occurring in the startup technology space. So what I think potential implications are, of course, we'll have to wait to see how it unfolds, is we may see a two-speed recovery in terms of both the technology names themselves, but also in terms of the hiring. As we know, not all technology stocks are made equal. You've got the cash flow generative companies that are currently profitable, strong balance sheets. Many of these mega cap technology names fall into that cohort. And then you've got some of the more earlier stage speculative names that perhaps have got great opportunities if they're able to succeed, get that flywheel going and really grow into that. But of course, they're much earlier stage and they haven't got current cash flows generating now. So it's going to be fascinating to see if we see kind of a divergence and a bifurcation in terms of the actual recovery itself, and ultimately how that will start to pick up pace. I'd love to know your thoughts. Drop in a comment below. Fascinating discussion. Check out another video on the channel. For now, big thanks for joining us. Stay well and happy investing.